Hello all, welcome to our channel. Of late, several prominent Indian names have been included in the Pandora Papers leak. There are at least 380 Indian names in the leak, including approximately 60 prominent individuals and companies including Sachin Tendulkar, Anil Ambani, Vinod Adani, Jackie Shroff, Kiran Mazumdar Shah, Niraa Radia and Satish Sharma. So, what this leak says about these entities and what the investigation is about will be our Chitti story for this episode. Pandora Papers are 11.9 million leaked records from 14 worldwide corporate service firms which set up around 29,000 off the shelf companies and private trusts. So, what do the Pandora Papers reveal? The Pandora Papers reveal how the rich and the popular set up complex trust structures for estate planning where secrecy laws are stringent. The main reasons for this setup is to hide their real identities and safeguard their investments. While the Panama Papers largely dealt with offshore entities set up by individuals, Paradise Papers were concerned with corporates. The latest Pandora Papers investigation shows how trusts are being used as a vehicle in conjunction with offshore entities for holding assets of the rich. Basically, a trust holds assets on behalf of individuals or organizations that gain benefit from it. It is generally used for estate planning purposes and succession planning. It helps large business families to consolidate their assets like financial investments, shareholding, and real estate property. A trust is not a separate legal entity, but its legal nature comes from the trustee. So, what does our Indian law states about trusts? The Indian Trusts Act 1882 gives legal basis to the concept of trust. Indian laws recognize the trust as an obligation of the trustee to manage and use the assets settled in the trust for the benefit of beneficiaries. Even though trusts are legal for genuine estate planning, they are being used by some as secret vehicles to park illegally earned money, hide incomes to evade taxes, protect wealth from law enforcers, insulate it from creditors to whom huge monies are due, and at times to use it for criminal activities. Let's see what are the reasons for setting up trusts overseas. The top reason is secrecy. Overseas trusts offer remarkable secrecy because of stringent privacy laws in the jurisdiction they operate in. Secondly, they maintain a degree of separation. Business persons set up private offshore trusts to project a degree of separation from their personal assets. Next is to avoid tax in the guise of planning. Business persons avoid their non-resident Indians, that is NRI children, being taxed on income from their assets by transferring all the assets to a trust. Further, to prepare for estate duty eventuality. There is a pervasive fear that estate duty, which was abolished back in 1985, will likely be reintroduced soon. Setting up trusts in advance will protect the next generation from paying the death or inheritance tax, which was as high as 85% in the more than 3 decades after its enactment. Next is its flexibility in a capital controlled economy. India is a capital controlled economy. Individuals can invest only 250,000 US dollars a year under the Reserve Bank of India's liberalized remittance scheme, that is LRS. To get over this, business persons have turned into NRIs, and under Foreign Exchange Management Act 1999, NRIs can remit 1 million US dollars a year in addition to their current annual income outside India. Further, the tax rates in overseas jurisdictions are much lower than 30% personal income tax rate in India. Lastly, grey areas of Indian taxation. There are certain grey areas of taxation where the income tax department is in contest with offshore trusts. After the enactment of Black Money, Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015, resident Indians have to report their foreign financial interests and assets, whereas NRIs are not required to do so. The IT department may consider an offshore trust to be a resident of India for taxation purposes if the trustee is an Indian resident. In cases where the trustee is an offshore entity or an NRI, if the tax department establishes that trustee is taking instructions from a resident Indian, then too the trust may be considered as a resident of India for taxation purposes. Now let's see what our Indian government's initiatives are. Legislative action wise, we have multiple acts, namely the Fugitive Economic Offenders Act 2018, the Central Goods and Services Tax Act 2017, the Binami Transactions Prohibition Amendment Act 2016, the Black Money, Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015, and Prevention of Money Laundering Act 2002. Our finance ministry has promised an investigation into the revelations in the Pandora Papers and assured of appropriate action in such cases as per law. The multi-agency probe is likely to involve the Enforcement Directorate, Central Board of Direct Taxes, Reserve Bank of India, and Financial Intelligence Unit. With a view to ensuring effective investigation in these cases, the government will also proactively engage with foreign jurisdictions for obtaining information in respect of relevant taxpayers or entities. Undisclosed credits of 20,350 crores of rupees, approximately as on 15th September 2021, have been deducted in the investigations carried out in the Panama and Paradise Papers. So we must wait and watch where this investigation on Pandora Papers lead to. That's all for this episode, viewers. Hope this video is informative. Please like, share and subscribe to this channel for more such videos. Thank you.